Shyam Sekhar, Chief Ideator and Founder at iThought. Shyam, good morning and thank you for joining us. Let me start by asking you about the key factors that you're keeping in mind at this point in time when you go ahead and approach Indian equity markets. Is it crude in the way prices are moving around? Is it the interest rates? What are those factors that you have in your mind at this point in time that could influence markets?
See, I think the macros are moving towards the second phase of challenge. The first phase of challenge which the economy faced from macros, the mid-sized companies did fairly well. And we also rewarded them very, very generously by giving them multiples which discounted far into the future. But in the current round of macro challenge that the economy is facing, I think that it is unlikely that very many companies are going to really be able to overcome this successfully and continue to maintain the same momentum in earnings. So I think that we are going to enter a phase of an earnings reset, which is going to be driven by challenges from the macro. I think that the market will eventually accept it, though the acceptance is coming rather slowly. I think the mid-sized companies, the mid-caps and lower, are going to gradually factor these in their valuations. So I would be very, very cautious in approaching these companies, and I would wait for the earnings to present themselves so that I can get a clear estimate. I also expect management commentary to change significantly at the end of this quarter and the next quarter. So I think one should keep a very close watch on the management commentary and compare the management commentary to the management commentary that we have heard over the last 2 quarters, and then understand the nuanced change that we are going to face as investors.
Hi Shyam, good morning. Let's drill it down to the broader markets then, and I believe this is the space that you also track pretty closely, Shyam. We've seen a lot of stocks correcting, and there's been issues like auditors resigning. There's also been a lot of stocks which have been placed under ASM by the exchanges. So these are a couple of factors which have actually, hampered the stock price movements, at least in the recent past. Just want to know if somebody wants to now, do some sort of value hunting in broader markets, what should be the approach like? Is there any theme that's emerging out for you?
See, I think the emerging themes which have been coming out, a lot of IPOs have been coming out in the last 1 year in healthcare, in insurance. You have been seeing some in fine chemicals. You have been seeing a lot of niche companies coming out with IPOs. These IPOs were definitely not priced at a valuation which is favorable to the investor. I think the investor should start looking at some of these companies from the angle of buying them later at a much more favorable valuation. I don't think there's any rush to invest in any of these companies right now, but I would think that that is one space where the market can find a lot of interesting opportunities going forward.
Shyam, you did speak about valuations to a certain extent. I want to equate that to the expectations of earnings, say over the next 1 year and perhaps the subsequent year. What are your expectations there? And based on that, what is your take on valuations for some quality out there in the mid-cap space?
See, when it comes to earnings expectations in mid-cap, I think we have to separate it into 2 subsets of companies. One subset of companies are those that have been excessively covered by research and which have been sharply in the focus in the immediate past. And the other is those that have generally not been covered because they have had headwinds or some of the macro factors were not in their favor till now. I think the 2 have to be dealt with separately. I would think that the companies that have had excessive focus in the immediate past have also seen over-optimism creep into our estimates of earnings. Be it investors or analysts, generally we have shown a very strong tendency to overestimate the earnings potential of these companies. I believe that it will be very difficult for many of these companies to live up to our expectations because we have been more optimistic than even the boards or managements of these companies. We have extended our expectations beyond management commentary. I believe that over the next 1 year, in most of these companies, the management commentary will soften, and investors like us will be forced to move from beyond the management commentary to well within the management commentary. I think that we are going to have a reset, which will be quite painful. And only post that reset, we will be able to really find good value bargains in that space. I am talking specific to the mid-cap space. I also think that the mid-cap space has been running on the fuel provided by lay investors through the mutual funds. I think that these investors are not candidates for very sharp cut in NAVs. Though we have still not seen the worst of the NAV movement, I expect the worst of the NAV movements to happen over the next 60 to 90 days. And how these investors will react to that NAV movement is something that the markets have not factored in. We should not take solace from the fact that institutional investors continue to support valuations of several companies because their investors are supporting them with fund flows. I think these are some of the points that I keep in mind, and it may help others also to consider them while they make up their minds on investments.
Are you waiting, Shyam, for more correction to come by in terms of valuation to deploy fresh money?
I mentioned two subsets. The other subset is where institutions are not there, where research is not there. In that subset, I think one is somewhat safer to buy into corrections because the corrections are also sharper and there is no risk of institutional redemptions or any other factors leading to sharp sell-offs. I think that today, if you are looking at companies in the emerging areas, mid-caps and other things, it is better to buy companies where there is very little institutional ownership. I think the biggest risk to investing today is the institutional ownership, particularly the mutual fund ownership in many of the companies presents a very significant risk going forward.
Given the fact, Shyam, there's so much of volatility not only in Indian markets but also globally, do you think it would make more sense to have more weightage on the large caps now versus the mid caps?
I think so. I think it makes sense to buy some of the beaten down macro themes because if you look at what will happen post resolution of this oil problem with Iran, you are going to see oil prices reasonably stable once that issue is put behind. I would think that in that scenario, the Indian economy will again start doing well. I would expect this scenario to emerge over 12 to 18 months. And in that scenario, you are going to see the growth in the economy once again regain momentum. So it may be safer to be in larger companies. One also has the option of going into the riskier parts of the market where you are expecting resolution of issues under NCLT, consolidation of companies, restructuring. I am talking about all this within the large cap space as well. But I think that only investors with a high risk appetite can go into those spaces, and I would include the PSU also in this because the headwinds related to the will of the government to reform further in an election year, all these factors will play out. So I think that one should be careful in even in the large caps, but relative to mid caps, I think large caps are much safer.
Shyam Sekhar, thank you so much for joining us this morning and giving us your views on the markets.